Advanced Financial Accounting Excel Practice Problem. In this presentation, we will work a practice problem within Excel where we're going to have a consolidation process with a wholly owned subsidiary. So we have a parent-subsidiary relationship, wholly owned subsidiary. The more difficult part here being now, there's going to be a revaluation of land at the point of purchase. In other words, the fair value differs from the book value at the point of purchase, and the purchase is going to be not for cash, but rather the issuance of stock. There's going to be an issuance of stock for the purchase, and now we're going to be at the end of year one. So we're not going to be putting this together right after the purchase took place, but a year later. So we're going to have income statement accounts, temporary accounts to be dealing with within the consolidation. Get ready to account with Advanced Financial Accounting. Here we are in our Excel worksheet. We got our information on the left. We're going to be putting that information into the blue area on the bottom, and to the right, we have our consolidation worksheet where we have the trial balances for our two companies, that being P and S, and then a consolidated balance sheet to the right. We're going to go all the way back to the left. Let's consider our data. We're going to say P purchased 100% of S. P is going to be the parent company. S is going to be the subsidiary. 100% purchased. That purchase took place, we're going to say, at the beginning of the year, January 1st. In this case, January 1st, X5. And at that point, and now it's a year later. So the consolidation is going to be happening in December. Therefore, activity has happened. Therefore, we have temporary accounts involved here. We have income statement accounts involved. At the point of purchase, it was purchased for, P issued, in other words, 41,000 shares of stock. So P issued stock in order to purchase the stock of S. So cash wasn't used to purchase, the issuance of stock was. The par value was $30 for P's stock that was issued to purchase S's outstanding shares, and the fair market value was $57.50. P uses the equity method to account for S. So when we're looking at this account right here, the investment in S, P will be accounted for that on their books using the equity method. Of course, we will have to remove that account with the consolidation. Book and fair value of S accounts were the same, except for land that had a fair value of the 542.5. So in other words, we're going to say, all right, the book value, if we were to say assets minus liabilities like this, assets minus liabilities of company S at the point in time of consolidation, not now, this is a year later, but if we were to do that at the point of time of consolidation, then the book value would then be equal to the equity section down here, right? The equity section at the point of consolidation. And those accounts would be the same as the fair value. However, and again, that's not the case here because this is a year later, so we've had that activity that happened. However, there was one account that if we were to bring it to fair value, land, it would be a fair value of the 542.5. So in other words, when we think about the point of consolidation, or when we think about the point of purchase, we could say, okay, you could think about it as if they purchased the assets, even though they purchased the stock. If we were to take the equity accounts, or the equity section, assets minus liabilities equaling equity at that point in time, what would it be? And then if we revalued the accounts, we'd revalue that one account. So thinking about that, we could think about the goodwill calculation. So let's say, okay, the fair value of the net assets before was, and this gets a little bit tricky here. I'm going to put a little trick in our practice problem to get this. So now I want to think about, okay, was there goodwill? Can I think about basically the goodwill calculation to do this? How would I know this based on this information? In practice, of course, you would have basically S's information at the point in time that the purchase took place. But right now we have S's information over here for 1 year later. It's been 1 year later. So is there some way that if I had like a book problem that they can give me this data and I can kind of back into what the fair value was, or the book value, assets minus liabilities? Notice I can't do it here because if I say assets minus liabilities, I'm going to get this $2,499,000. Or if I was to take the equity, I'm going to get the $2,499,000. But that's a year later. What I really want is to be able to do that a year ago, which I don't have that data right now. But I do have the fact that I have the equity section here. Common stock isn't going to change for S since the point of consolidation in that year. That number is going to be the same. The additional paid in capital isn't going to change since the point of time that this took place either. And the retained earnings has nothing that happened to it either since it's only been 1 year later. Therefore, the net income on the trial balance hasn't been closed into it yet. And if it had dividends into it, we'd have to consider that. But we broke the dividends out here So they're not in there either. So these three accounts represent the equity section, or assets minus liabilities before the, a year ago at the point in time that the purchase took place. So a book, again, in practice, you would have the prior information when the consolidation happened, but a book problem could ask you for that and give you like this information, and you'd kind of have to back into it. And you say, all right, well, they gave me this. I know that then if I take the negative sum of this, and this, the equity section not including the dividends, that gives us the $2,177,000. That's the book value before or a year ago, because assets minus liabilities equals the equity, and that's what was in equity a year ago. So then we're going to say that there's a difference in the amount for the land now. So the land then, we're going to revalue at the 542.5 minus what it's on the books for, which is the 302. So that's going to be the 240,500. Therefore, the fair value of S at the point in time of consolidation a year ago, from the data that we see to the right, would be the 3 million, or the 2,557,500. Okay, so now we have to compare that to how much we paid. Now, we didn't pay cash. So you would think, well, if I issued stock, can't I just assume if I fair valued this side that the stock was the same? You can't. Why? Because there could be goodwill. There could be goodwill over here. Even if you properly fair valued these things, you can't just assume that the stock was priced at the same value, because there could be goodwill involved, and that wouldn't be on this at all. So I have to revalue this stock at fair value. How would I do that? Well, if the stock was publicly traded, then I could just see what it's trading for, or I have to come up with some kind of calculation for it. So the fair value is going to be the number of shares times the fair market value, not the par value. So I'm going to say, all right, the stock that we issued is worth, that P issued. When I say we, I think of ourselves as the purchaser here, the parent company. 41,000 times the 5750. That's going to be the 2,537,500. So no goodwill is involved here. We didn't purchase just for the book value. We purchased for something more, P did. However, that something more wasn't due to goodwill, we're saying. It's due to the fact that one of their assets, land, was undervalued, and we're going to account for that over here when we do the consolidation. Okay, same starting point for the consolidation process. We're just going to sum up. We got P's trial balance, S's trial balance. We'll sum them up over here in K equals the sum. So I'm just going to sum these across, and then I'm just going to copy this and paste this on down. So we're going to go on down and paste that like so. Control V, and there it is. So we have something in balance. Now I'm going to go through here and do our elimination or consolidation entries. So first, we note that this investment account is gone. So instead of doing like well, we could do this in a couple different ways. We could break this out in basically 2 journal entries instead of 1. And sometimes I would think about it, it might be easier just to do 1 long journal entry. But let's think about breaking this thing out into basically 2 entries. Before we do so, let's first think about, okay, how did that get on there again? We're going to use the equity method to think about where did that number come from? Well, we know down here, when P purchased the stock, they're going to say, it would look something like this. We're going to say, well, P issued common stock, so the common stock would be the 41,000 times the 30 par, and then they have the additional paid in capital for the difference, because the amount that they included was 41,000 times the 57. That's the fair value, and therefore the difference is the additional paid in capital. So this would be kind of like they paid cash of, if you can imagine the credit being cash, of the 2,357,500. Now they issued the stock for that, and the investment goes on the books. Then we saw that S earned income of the 587. P owns all of S during that whole year. Therefore, P recognized the investment going up by that amount, and income here of that amount. There's the income there. So just as we've seen in prior presentations, equity method. And then we know that S issued a dividend of 205. That dividend went to the stockholders. It's fully owned at this point by P. Therefore, P has the 205, and the investment went down then by the 205. Effect on the investment then, increase, increase, decrease, right? Increase, increase, and then decrease. And that's how we get to that 2,739,500. There's the 2,739,500. So it's useful to kind of, break that down, understand that thoroughly in your mind. Now we're going to say, all right, well, I know that's got to go away now in our intercompany transactions. So I'm going to say that this is going to be equal in that. Now I'm going to do this with 2 journal entries now. You might want to, I think it's easier sometimes just to do 1, but let's break it out into 2. So, and that might be easier for some people to kind of, to break this down depending on how you work this through in your mind. So I know that I'm going to remove the S's equity section. S's equity section basically has to remove. I'm going to use the difference being the plug to the investment, which will be a credit. And again, I'm not constructing this debits on tops, credits on bottoms, but in the way that makes the most sense to me. So equals, and hopefully it makes the most sense to you that way. And that's the only way I can explain it in the way that makes the the most sense. But I'll try to explain it multiple ways. But in any case, we're going to say the common stock. We're going to be removing that. So we'll remove the common stock here. So there it is, removing the common stock. And then we're going to remove the additional paid in capital. So I'm going to remove the additional paid in capital for S. So we're going to remove that. So I'll take away the additional paid in capital here. And then we're going to remove the retained earnings. So let's go on down to the retained earnings, and we're going to remove the retained earnings. So let's get that gone, And then the dividends, we also have to remove the dividends. They went 100% in this case to P, so we can't have dividends paying themselves. It's a debit over here, so we're going to credit it. And notice how much easier it is to do this if you actually have a trial balance in front of you. So if you have a book problem and they don't give you a trial balance and you have to figure out, what is going on, if you try to visualize this without first constructing the trial balance, your task will be much more difficult. It'll be easier to construct a trial balance with whatever information they gave you a lot of the time until you can just visualize this, which most people cannot do for quite some time. Okay, and then we also note we can remove this side of the equity, revenue minus expenses here. But I want the detail down here. What I'm going to remove instead is instead of removing the accounts that add up to the net income, the 587, we're going to be pulling over the 587 here. We're going to remove this account, of course. Income from S needs to be removed. So I'm going to say, all right, income from S, I know that has to be removed. So I'll just pick that one up. We'll just pick that one up. And that's a credit, so we're going to debit it to make it go away. So I'm going to make it go away with a debit. Now, if we had no revaluation happening here on the purchase, if the purchase was made for the book value, as we've seen in prior presentations, then the difference, the plug, if I did my little plug entry up here, would equal this amount, as we saw in prior presentations. But that's not the case because we have the land that need to be revalued. So in other words, if I use this as my plug entry, I'm going to say, all right, negative sum, and say I need to do whatever I got to do to make that in balance. That's going to be the $2,499,000. That doesn't equal this amount. Why? Because of the difference in the valuation of the land. And let's break that out in a separate journal entry. So let's post this out first. I'm going to say, all right, so there's the investment. Doesn't tie out that, but I know why. I'm not too upset with that. So I'm going to say equals. I'm a little upset, but not like really upset because I can figure it out, I think. So that's going to be, notice it leaves the $240,500. And then if we go down to the common stock, so the common stock down here, we're going to say this equals, as we've seen before, the $1,230,000. So then we had, this was P's, this was S, this is added together. We removed S's then, leaving us with P once again. And then we'll post the additional paid in capital. So additional paid in capital here in L13 equals, scrolling on up to the 173. So once again, here's P's amount, there's S's amount, there's the total. We removed S's amount, left with P's amount again. Retained earnings, so here's retained earnings. So we'll scroll on down, we'll pick up the retained earnings, this equals, and then we're going to go on up to that 714, the 714. So there's P, there's S, there's the total, removing S back to P. And then the dividends, same thing on the dividends. So we'll go to the dividends here, equals, and we're removing the dividends for S at the 205. So there's P's, there's S, there's the total, there's the removing of S. That leaves us with P amount once again. Then we're going to go to the income. So we got to get rid of that. That doesn't make any sense. We can't be paying ourselves in the consolidated financial statement. That looks funny. We want to remove funny looking things. So we'll get rid of that. And that makes it go down to 0. Okay, so that's good. So now we just need to deal with the second transaction, which is going to be dealing with the we know we have to get rid of this 240,500 now due to the fact there was no goodwill involved. That should hopefully be simply the difference in whatever the revaluation of the assets were, in this case the land. So in other words, we said that the land at the point of purchase had a fair value, which we're now going to account for, of, we said that 542.5, and we have it on, and they have it here at the 302. So the difference is that 240,500. It matches. Whew! I was a little worried for a second. That was a tense moment because that's ties out. So then that's going to be the credit. So that should take care of those two accounts. So I'm going to say equals here. And then we're going to be picking up the investment. So that's going to be our last journal entry. Now, to me, I would just do all this at one time and do that because then I would just take off the whole amount up top and then take off and then revalue the land and just have one long journal entry kind of makes more sense to me. But I can see why breaking it out in this two-tier thing could be a good way to see it as well. So we'll probably combine them together in later transactions into one long journal entry and put these two transactions up top. In any case, let's post it out. So land, we're going to go back on over on L7 equals, and we're going to scroll over to that 240,500, and then we're going to go to the investment. Let's go back to the investment. Something's in it. So I'm going to say F2 plus F2, and then scroll on down to the investment, and that should remove the investment. So now the investment has been removed, and it looks like everything is good to go for our major consolidation accounts. Note that we didn't do a revaluation for the accumulated depreciation because we're basically kind of reporting them net here, and we've seen that a few times, so that's not where our concentration is. And then and that's going to be it. I won't make a balance sheet right now because it's pretty straightforward here. We don't have anything unusual. We don't even have the goodwill here, and the equity section is fairly straightforward because it's 100% owned at this time.